Okay, so I think we'll get started. So welcome everyone. It's really great to have you here today to our very first Fisher Funds webinar. My name's Kath Lomax and I'm the Chief Client Officer here. And we're really delighted to have the investment team who many of you have heard or listened to some of the videos we've had recently. But this is a great opportunity for you to hear from them about what's been happening with your portfolio, what investments excite us at the moment, and at least, you know, what are we thinking about in terms of the first, coming out of the first stages of the pandemic. So during these unusual times, we're really adapting to the environment that we have, and so we really want to invite you into the home of Fisher Funds. So I'm here in our TV room, and although it might look nice in the background, there is a lot of Lego underfoot, just like to say. So before I introduce the team, I just wanted to run over a couple of things if you're not familiar with using Zoom or how a webinar like this works. So only your attendance is not visible for any of the other attendees. Likewise, presenters, and the investment team and myself will be the only one that can share our screens or audio, so your screens and audio won't be shared by anybody else. We really would love to have your questions. So if you see at the bottom of the screen, there's a Q&A button, which I can see already has got some questions in there, Frank and the team, which is great. So please type your questions during that and we'll do our very best to answer those as we go. And if not, then we'll answer those or get back to you as many as we can afterwards. And we really want to hear your feedback around what's worked well for the webinar and what could we do differently to improve on for next time. The other thing just to mention is this webinar is general information only. It's not financial advice, and everybody's investment objectives and financial goals or situations for a particular person will be different. So we really invite you to get in touch with your advisor following this if you have any specific questions, and I know they're really enjoying chatting and hearing from our clients at the moment. So yeah, a really great welcome and big thanks to Frank and the team. So I'm going to hand over to you, Frank, and welcome to Ash, Robbie, Sam and Dave for running our session today. So thanks.
Very good, thanks Kath, and look, thank you very much everybody. Look, before we talk about investment things, I think it's really important to acknowledge that we're living through really difficult times for all of us, actually, very difficult times for, thankfully, luckily, mostly overseas, but for people's health, the outlook for their jobs and their careers, the outlook for their families, and those things are just critically important. And I think they're very much figuring out how we think about investing right now and the decisions we're making. They're figuring out how we manage our team, and how we interact as a business, actually, and how we interact with our clients. So really, really important thing to, I think, say before we talk about managing your money. That, you know, these are things that are very much centre of our thinking right now. Format for today is that the portfolio managers and myself will all spend sort of 4 or 5 minutes giving a quick, very much thumbnail sketch of what we've been up to in our respective areas, the key sort of highlights and lowlights and the observations we're making about markets that I think speak to how things will play out from here. And then, as Kath mentioned, please do use the Q&A. We've already had one very good question around whether or not I've lost my razor, and if you look at the beatific faces on the screen here, you'll see that there's a few of us trying to grow a little hair. We keep trying to talk Robbie into doing it, but he refuses to. But yeah, so you know, there's a bit of it's fair to say dress standards have slipped just a little, being back at the ranch. Yeah, Carmel would not be happy with us if she was still in the house. Before I talk about how we're thinking about portfolios and markets, I just wanted to quickly touch on how we're actually managing your money while we're in lockdown. And the good news is that as a business, we had made a significant investment in technology really in the year preceding coronavirus. Actually, sort of as it turns out, it was a very fortuitous investment. We rolled out all new trading systems, we rolled out all new data systems, risk management platform, so that we really could manage your money from literally anywhere around the world. Up until that point, we did need to be in the office. We did use more spreadsheets than I'd like, but we had, as I say, moved away from that in the last year. So as it turns out, that proved to be a very, very wise investment, a significant one by the firm, and big thanks to our head of trading, Angela Quirk, who spent many, many hours putting that in place, but that has paid off big time. So as you see, if you see Dave's photo there, he's got his screens in the background. We're fully running at home, almost in exactly the same way that we're running at the office, with the big proviso that communication is really tricky, actually. So we're being really mindful about how our teams work together, how we work as a full investment team, and really keeping that communication up and running, and putting a lot more emphasis on it than we would around the office. I certainly know that I'm missing hanging out with the team at work, but it is working really, really well. So from that point of view, your money is in good hands. The second thing that I wanted to talk about was to give a sense of how we're thinking about markets through this period. And what I'm bringing up on the screen here, hopefully it's working, is a kind of 4-step process that we've been thinking about the journey of coronavirus and how that impacts financial markets, and almost breaking it down into these 4 distinct buckets. So we first and foremost had this initial sell-off as coronavirus really jumped the oceans from China to the Western world. It turns out the Western world didn't seem to pay that much attention to it until it really did that. But we saw a significant fall, for instance, in the US market as coronavirus began to impact in Europe and in the US. At its recent lows, the US share market measured by the S&P 500 had fallen 33.9% in that kind of sell-off phase. If you've been following our videos or reading some of our written material, you then will see that we've talked about this idea of what will it take to get stability in markets, and we were really looking for 3 things for markets to get some level of stability in them, and that is really around the monetary policy response, and Dave will talk about that in a bit more detail in a moment, around what governments are doing, so the fiscal response to the virus, and then last but not least, what the virus progression itself looks like. So, what are those daily trends of new cases, of people that are getting better, unfortunately people passing away. And the thesis there was very much that as we see new case progression begin to slow down, that would be quite an important step forward for market stability. And I think, if you've been watching markets in recent days, and stability is not the right word, because in fact it's been more like a rampant bull market, but we have seen a 2-way market return. We've seen buyers prepared to step up and buy shares, and quite a strong market over the last few days. In fact, it's up, over the last week or so, it's up over 20% from those lows. So I think we can definitely say that we've had the sell-off, the initial sell-off phase. We've seen a period of stability, at least for now. We though are not convinced that this stability really reflects the reality of the next phase of coronavirus, and that's the phase that we really feel like we're entering into right now. What is reality about? Well, it's about the things that could go wrong, and it's about the things that could go right as we really grapple with the real economic, the real Main Street impacts of coronavirus on our lives and on our jobs. So the challenges, I think, the list of challenges is too long for me to go through right now. But a few simple examples paint a pretty obvious picture here. If we think about our own country, we think about New Zealand. International tourism employs about 1 in 11 Kiwis in the workforce. International tourism is closed probably until we get a vaccine. So right off the bat, if we can't repurpose those jobs to domestic tourism, 1 in 11 Kiwis will lose their job just as a result of that one thing, and one thing alone changing. And that's before we think about social distancing, large events not happening, restaurants and cafes not opening that soon. So the reality of what we're going to be grappling with for some time now in those sorts of areas is huge. 16 million Americans have already lost their jobs. So it's going to take time. Similarly, businesses are all going to be pretty cautious right now. They're not going to be investing a huge amount of money, and business investment is a huge part of GDP around the world as well. So these things, there are not quick fixes to them. And again, if you're reading the press a lot, there's a lot of talk about shapes of recoveries and what this will look like. And frankly, I don't think anybody knows. Suffice to say that it will take time. So I think at some point, markets are going to have to grapple with that reality. Of course, while there are negative things we could focus on, there are, of course, plenty of optimistic things as well. So there is real balance in this idea of the reality phase of the market. And what are those positive things? Well, central banks and governments continue to do things to support the economy through this really difficult period. So, and again, Dave and the guys will touch on this in a moment, but the size of the packages, the initiatives being undertaken just get bigger and bigger every day as governments and central banks step up to support the economy. And on the scientific side of things, I think it would be always very unwise to bet against human beings' innovation and their ability to get their head around difficult problems. Right now, there are some of the best firms in the world, some of the smartest people in the world, putting their mind to how do we develop antiviral drugs that help manage COVID-19 if you're unlucky enough to get it, and working on vaccines. And not only that, there are billions of dollars being invested in making sure that when those new drugs do get discovered and when they're proven to be safe, that we can gear up production of those and basically roll a vaccine out to the billions of people around the world. So I think betting against that in the long term is a really dumb thing. These solutions will be found. The science will come to our rescue, but it's going to take time. And I think balancing that risk with that longer term view, I think, is really important to navigate the next phase of the market, which of then course leads through to that recovery phase. And that's all about a vaccine. It's about the word I don't like very much, but the herd immunity word, and it's about life getting back to normal in some way, shape or form. Of course, it won't quite ever get back to normal in exactly the way that it was before that. My final comment that I wanted to leave you with before handing on to Dave is that things will, in some way, shape or form, be different in a year's time and 2 years' time than they are today, and than they were 2 years ago. What that means is that the outcomes for companies will be different. Some companies will be winners out of this. Some companies will be losers out of this. Some companies will muddle through in some way, shape or form. What you do know, though, is that those differences will be there, and that, for us, is a really fertile environment for picking better than the average companies. So we think our ability to handpick the right companies, to do the sort of research that we've always done, it's always important. In today's market, it is even more important than normal. So really doing the work that the team will talk to you about at the moment, I think is of utmost importance today, as I say, more than ever. And I think we've got some good stories to tell. So before we talk about equities, though, the cost of money and what's going on in pure financial markets, I think is always a really good place to start any conversation like this. So I'll hand over to Dave, who can talk to you about what's going on in fixed income markets, what all these big central bank programs look like, and the alphabet soup of different things that we keep reading about in the paper every day. So Dave.
Thanks, Frank, and thank you everyone for joining. I hope you're all staying well. Yeah, Frank talked about the cost of money, and the cost of money is simply the level of interest rates in an economy. And as I think we all know, they've really collapsed. And, you know, although I don't have 5 hours to talk to you today about how we got there, it's suffice to say we have been on this path to lower and lower interest rates for a very long period of time. It's just that this very last leg down to what I would call the lower bound, which is a point very close to zero, if not at zero, in the official cash rate here in New Zealand or the equivalent overseas. And we've now sort of exhausted all options when it comes to conventional policies. But so let's focus on the recent developments. As Frank pointed out, the coronavirus has played havoc with markets in March. In particular, the funding markets, which are the markets that we in fixed income invest in. These are the markets in which governments and companies actually fund their businesses and their operations. those markets around the world seized up. They seized up to the degree that really they stopped functioning for a short period of time there. And to use sort of a metaphor, money and the circulation of it in funds is really the oil inside of the economic machine. So if there is no oil in that machine, it seizes and seizes very, very quickly. So what we've seen is, as I just mentioned, the exhaustion of conventional monetary policy, which is just interest rates. In many parts of the world, including here in New Zealand, we've dropped them down to very close to zero, or that lower bound. And we've now actually seen the advent of a whole new range of not only monetary but economic backstops that have been put in place by not only central banks like our Reserve Bank in New Zealand here, but also the governments around the world. So I'll give you a little example of how large this response has been. And I'll use the US because it is the largest economy in the world, and it obviously has the US dollar, which is the reserve currency of the world. So what happens in the US really does impact the entire world quite dramatically. So in the US, the Federal Reserve has bought $3 trillion worth of a wide range of bonds in just the last month, right? That is a pace like nothing we've ever seen before. In fact, it is at a quicker pace, in fact, a factor of 20 compared to any other experience in history. So they have taken the bull by the horns, per se, and they have really run with this one by injecting a very, very large amount of money into that system, that oil, back into that economic machine. And governments, certainly not to be underdone, have obviously come out with a number of very, very large stimulative packages as well. You would have seen a number of them here in New Zealand, and Frank alluded to the alphabet soup, which is really all the acronyms that a lot of these programs have been given. I won't bore you with any of those details, but it's safe to say, using the US again as an example, their debt to GDP is now set to top 100% by the end of the year. That'll be the very first time that it has reached it since World War II. So again, uncharted territory, and as far as the response from both the fiscal side, the government side, and the monetary side from central banks. But what really is, what's really grabbed us and grabbed me when it comes to investing your money is one particular decision that took place between the Federal Reserve in the US and the US Treasury, which is the government largely. They broke the rules effectively as of last Thursday, so just before Easter. They, under the Federal Reserve Act, the US Federal Reserve is not allowed to buy corporate debt, but through an agreement whereby the Treasury funds that acquisition, the central bank is now acting as an agent and going out there and buying corporate bonds out of the secondary and primary markets. That is really a very pivotal point in this entire crisis for me. What I mean by that is the chairman of the Federal Reserve came out at the time that they made this announcement and said, and I quote him, "We should make them whole. They are not the cause of this," which he was referring to businesses, employers. He was talking very specifically about bailing out corporate America. The European Central Bank is doing exactly the same thing in Europe, and I wouldn't be surprised if other jurisdictions around the world, maybe even here in New Zealand, our own central bank moves to such initiatives in a relatively short space of time. So why is that important? Well, why that is important is that their intention is to ensure that businesses don't go out of business, they don't default. Now, when you're a corporate bond investor, that is the biggest risk that you bear. By lending your money to a company or corporation, the biggest risk is that they fall into trouble and they can't pay you back. If now, fast forward, and we're in a situation whereby an unlimited balance sheet is going to be funding this company or many, many companies around the world, it certainly makes investing in corporate bonds a lot less risky, in my opinion. When you add to that the fact that actually the yield or the interest rate on corporate bonds has risen quite dramatically thanks to the panic that we saw of March, granted, that level of interest has come back down as people step back into the market and become more confident on the back of these actions. But that level of interest is still significantly higher than what you would get in government bonds. And so what have we been doing recently? Well, what we've been doing is we've been selling some of our really high quality safe haven government bonds, which have done us so well through this crisis. And we've actually been investing into some of the corporate bonds of this world that have not fared so well, and I think will begin to fare very well now that the central banks around the world have got their backs. What are the types of companies that we're buying? Well, we've invested in some of the US and European banking champions. We actually see the banks as part of the solution rather than the problem now, in the sense that they are going to be the conduit or part of the mechanism of distributing stimulus, and also they are the true creators of money. So we need those banks to be in good health to be able to ensure the recovery of the global economy in due course. So we think that's a good place to invest. And the other one is, in companies that are going to thrive, or winners, I guess, in this brave new world. Those are things like telecoms. Clearly, our reliance on Wi-Fi and the internet has shot up to a completely different level, I think, on the back of this. I think that's here to stay. Pharmaceuticals, even Netflix. Clearly the viewership, I think, has increased quite dramatically there in recent months, and I think they've got a fantastic platform. So we've been investing in companies like that. I guess just to finish, the performance-wise, as you would expect in a very, very tough first quarter of the year, the Premium Income Fund performed rather poorly. It fell by 0.2% over the quarter, but thankfully on the back of a slight recovery, as Frank alluded to earlier, the fund is now well back into positive territory for the year, up around 0.6, 0.7% for the year. So it has been a relatively healthy recovery quite quickly. Again, the big detractors were banks, who have been seen as ones at risk, I guess, of higher delinquencies from their customers. And the other one was, the other big detractor for us was Synlait. Unfortunately, they came out with an unexpected profit warning in February, so before all this really kicked off. So the bonds have never really got their footing since then, but you will note maybe that the stock of Synlait has bounced quite strongly in the last couple of weeks, and we expect that the bonds will follow suit in due course. And as I mentioned earlier, the key contributors, the positive factors to the fund have been our government bond holdings, which have put us in such great stead recently, which I think now have got to the point where they're kind of a bit overvalued, and there is better value in corporate bonds.
Great, thanks Dave. Now hopefully my screen sharing technology is working here. So every now and then you'll see the screen change to a Bloomberg screen, and what we're trying to do there is just show you some of the underlying data to the extent that you can actually follow the screen, because some of these titles are a little obtuse, but the screen I popped up there was just showing how much investment grade bonds had sold off and then rallied back as the government started buying them effectively. These are things you don't expect to see in your career. Actually, they're for a financial geek, they're kind of interesting. Ash, so we've said that we think there's these great opportunities for stock pickers in this market. We're now about to hear from the stock pickers. So Ash, tell us some things to buy.
Yep, great. Thank you, Frank. And I will get to that towards the end of my points here. And I think it is interesting to talk about that, because bear markets are actually where you do find the best opportunities. But what I wanted to do today really was to talk about three key things. And firstly, just what we're doing right now, or what we've been doing over the last couple of weeks in our portfolios. I'll talk a bit about performance and give a bit of an update on that over the first quarter, and then talk about some of these opportunities that we are seeing. So firstly, well, what are we doing right now? And there's two things, and the first one is what we call safety first. We've really been focusing for the last month on getting in touch with our portfolio companies, updating our analysis, making sure that the companies that we invest in have sound balance sheets. We've got plenty of cash and liquidity to not only get through this difficult period, but but ultimately to come out the other side stronger. And through the process of talking to all those businesses over the last month or so, we have gained a lot of confidence that that is in fact the case, and the companies in our portfolios will not only survive, but they'll thrive in the environment on the other side of that. And just one example in the portfolio of that, which is a good one, I think, is Google. We've been invested in Google for 6 or so years now. We think it's a phenomenal business. It's got $100 billion of cash on its balance sheet. It's going to sort of sail through this environment with that cash balance. But a lot of its competitors, whether they're print media, media networks like TV or radio, they're really going to struggle in this environment. And we're already seeing a few names in that sector go bankrupt or go into receivership, and that will ultimately, on the other side of this, benefit companies like Google. So that's a name we've been able to add through this difficult environment. So the first thing was safety first, and just really checking in with all of our companies. And the second point where the team, so Chris, Harry and I have spent a lot of time in the last 2 weeks now, is trying to find new investment ideas, and I'll touch on that at the end of this conversation. But first, just quickly on performance, it was obviously an extremely difficult period in global share markets in the first quarter. Pretty much all major global share markets were down at least 20% in the first quarter, from the start of the quarter to the end of the quarter, but during the quarter they were down more like 30%. So with markets down 20% in the quarter, the Premium International Growth Fund did fall. It was down about 10%, but it was effectively fell by 10% less than the market. Now, why was that? Well, it really comes back to the Fisher Fund's investment process and our investment style. We invest in high quality businesses, companies with high profit margins. Most of the companies in our portfolio have net cash balances, so they're in a very strong financial position, and that ultimately helped us out in this environment. Frank's put a picture up on the screen here of Amazon, and this is one of the top performers in our portfolio this year. Actually, I think it's up 20% for the year, despite the falls in the market. So we were also helped by some of the technology companies we own that have done very well in this environment. So Amazon is a great example. Not only do they have a good, strong balance sheet, but they've also benefited from the situation. The demand for e-commerce has been extremely strong. To try and meet that demand, they've had to try and hire 175,000 new workers on the fly. And also their cloud computing business has really benefited from that. So when we look at our performance, it really has benefited from individual company-specific stories like Amazon. Now to move just quickly on to opportunities, and you do find the best opportunities in bear markets. It can feel a little bit nerve-wracking at the time when you're looking at them, but the reality is, in this sort of environment, a lot of investors become extremely short-term focused. They only look at risks, they don't look at the opportunity. And by being able to take a longer-term perspective and look through some of the near-term disruption, we think you can ultimately find some pretty good investment opportunities. One that we did invest in about a month ago now, in the middle of March, was Starbucks. It was a company that we followed for many years. It's a company we've never sort of ever invested in because it always felt a little bit too expensive, but they have a great track record. They've got 30,000 stores globally, but they're adding an extra 2,000 stores every year. And a large part of the growth story here is actually China. The picture on the right there is actually a Starbucks. It's called their Reserve Roastery. I went to it in Shanghai a couple of years ago. It's one of their huge stores in China. But ultimately the aim is to have as many Starbucks in China as they have in the US. And we think that provides many, many years of growth. Obviously in the current environment with stores closed in the US, that caused a lot of concern for a number of investors. But with the share price falling 40%, we simply thought it was too good an opportunity to pass up. Coming out the other side of this, we're all still going to be addicted to coffee, perhaps even more so. We're going to want to get out of the home and go to a coffee shop. Ultimately, they'll open their stores again, they'll return to growth, and we think in hindsight it will turn out to be a good time to have been buying. But it's not just Starbucks. We've added a couple of other companies to the portfolio as well. We've also just simply topped up companies that we really like that went on sale. So we added to our positions in PayPal, Facebook, heart valve manufacturer we really like called Edwards Life Sciences, and we also added to Amazon. So it has been a good environment from the perspective of new opportunities as well. That was it for me, just a quick update on the portfolio, and I'll pass it on.
Great, thanks Ash, that was very helpful. Robbie, Australia, what have our cousins been up to?
Yes, well, yeah, thank you, and thanks for joining everybody. It feels like an extended team call, which we have pretty regularly these days. So thanks for joining. Yeah, so from Team Australia, the Australian Premium Fund, I'll just start off by recapping on performance. March was obviously a pretty tough month all round. The Aussie Premium Fund was down 18% on a net basis in March, which puts it about just over 2% ahead of the index, which was down 20.7% over the same time frame. If we think about it over a broader time frame, however, over a one-year basis, the returns, while still negative, are a bit better. The premium fund in the 12 months to March returned -6%, which is about 8% ahead of the index, which was down just over 14%. I'll just turn specifically to March though, because clearly that's where all of the action has been in terms of the equity unwind. And I'll just take you through, give you a flavor for what worked in our portfolio and what didn't work so well. Starting with the negative, O Media, which is an outdoor advertising company that we've been invested in, fell 70% in the month of March and was our worst performer by some distance. This is primarily because it had balance sheet issues. It just had too much debt as an advertising business coming into a very sharp cyclical downturn, and hence the share price got hammered. The company, to its credit, acted quite quickly, and they raised $165 million in fresh equity to de-gear and put the balance sheet issues to one side, which they did towards the back end of March. We participated in that equity raising, and what's been pleasing is that, having dealt with the balance sheet issues, we've seen the share price re-rate 40% in the first couple of weeks of April. Other companies of ours that didn't do so well in the month included our financial services exposures. That's really made up of the shareholdings we have in the 4 major Australian banks, as well as Credit Corp, which is also a financial services business. They were all down between 20 and 50% each, just because I think the market is obviously very concerned about their exposure to a sharp economic downturn. From our perspective, we think all of these businesses, while they're clearly going to have rising impairments in this environment and their earnings will suffer near term, all 4 of the major Australian banks come into this crisis with very strong balance sheets, as does Credit Corp. So we're quite comfortable with their longer term outlooks. On the other side of the ledger, we did have a few businesses that held up reasonably well. And I guess the first bucket of those really are the companies that we're invested in that are focused on the digital economy and benefit from a rising consumption of internet usage, as well as, I guess, data usage. And increased internet and data requirements is, that's just a thematic that we think has been accelerated by COVID-19, both in the business context as well as, for consumers at home. And businesses of ours that benefit from that trend include the likes of NextDC, which is one of the largest data center owner operators in Australia. Its share price was up 13% in the month of March. And we also have some software businesses that are also exposed to that, including Technology One and WiseTech. And then I guess another bucket of companies of ours that did reasonably well were those that had, no surprise here, that had really strong balance sheets and defensive earnings characteristics. For us, that included our healthcare names like CSL and ResMed, as well as an industrial company, Brambles, which is a pallet supplier to the global supermarket chains. So that's one of our companies that is actually benefiting from panic buying. So that just gives you a flavor for, I guess, how the portfolio went over the course of March. Also, similar to Ash, just turning to what our team has been focused on, Terry, Delano, and myself, who make up the Aussie investment team, we've really focused our energies on 3 areas. The first is we've kept very strong open dialogue with all of our portfolio companies, again, focused on balance sheet, making sure that companies are doing what's required to do to make sure that they're in the best shape possible to survive the near term, in terms of, Ash spoke about safety first. And then also we've been quite interested in how they are looking ahead of that and focusing on the long term. We've been quite impressed with how companies are balancing, I guess, in some ways competing objectives, managing for the short term to get yourself through so that you can benefit when the recovery ultimately comes. Secondly, we've been reweighting our portfolio. So we've been increasing our weightings in what we regard as high quality companies, those companies of ours that have strong competitive advantages around their businesses, and can benefit quite strongly when the recovery comes, and whose share prices have sold off. So to that end, we've been adding to the Australian banks after their significant falls. Credit Corp is another name we've been adding to, Seek, and to a lesser extent WiseTech. And we've been taking the capital away from, or reducing our positioning in those companies in the portfolio whose earnings characteristics, or whose share price characteristics don't have necessarily the same upside, and or where they have narrower competitive advantages around those businesses. So in reallocating the money to the higher quality names, we think we're doing two things. One is improving the strength of the overall portfolio to see us through this downturn, and secondly, we're positioning the portfolio to benefit when the recovery does come. And then lastly, we've really been determined not to waste this crisis. And so we've kept an eye out on high quality businesses that in the past we've found too expensive to purchase. One of them, Frank has just put up on the screen, is REA Group, which is an online real estate advertising business in Australia. And March, the sell-off gave us an opportunity to enter the stock at what we think are reasonable prices. Near term, its earnings will be impacted because house listings are down. People aren't going to many live auctions when you have social distancing requirements put around you. But over the next 3, 5, 7 years, people will be buying and selling their houses, and when they do, they're going to be advertising them in REA. So we've added REA, and I guess as this crisis continues, we're going to keep our eye out for similar such opportunities in the future. But that's roughly how we've approached the portfolio and what we've been up to in Team Australia.
Great stuff. Thank you, Team Australia. And by the way, do keep sending your questions in. We're getting a few coming through, and we'll begin to tick those off as we get to the end of the formal presentation. Sam, bring it home back to New Zealand. What's happening in our world?
Like Robbie and Ash, I'm just going to talk about this in 3 key sort of areas. So process, performance, and positioning. So on process, like Robbie and Ash, we've spoken to our companies, but not just our companies, their competitors, their customers, their suppliers, more than 150 times in the last 6 weeks. So our process has really gone into overdrive during this period. And we've been asking our companies 4 key questions. Firstly, how are you ensuring the safety of your team? So that's really important. Secondly, how's your balance sheet looking? How's your liquidity position? And thirdly, and this is a really tricky one to answer, but we ask it anyway, is what's the likely outcome for your revenue and profits during this period, but importantly out the other side? And fourthly, and possibly most importantly, how are you going to come out the other side of this as a better company? And that fourth one's really important because, like Ash said, it's often dark before the dawn, and companies and investors can get quite myopic and just focus on that really bearish picture right in front of them. So it's been really refreshing during this process to talk to some of our largest companies like A2, Fish and Paykel Healthcare, and Xero, and they're really, really focused on that number 4. So how can they come out the other side of this a better company? And there's 3 key takeaways from our best leaders to come out of this process that we've been undertaking for the last 6 weeks or so. The first one is that the best leaders are compassionate during a time like this. It's really important to look after your most valuable asset, and your most valuable asset is your people. And it came as no surprise to us to hear from Mainfreight and from Mainfreight's people that at a time like this, they're really, really proud to work for Mainfreight. They're proud to be keeping the goods of New Zealand, but also of the globe flowing during this period. The second one that's come through for us is our best leaders are calm. So it's always important to be calm, but especially right now. And the third thing that's come through from our best leaders is it's really important to be prepared. So I'll give you an example there. Somerset, by definition, one of their key drivers is house price inflation. And that's something that's completely outside of their control. So stress testing their balance sheet and their earnings or income statement is really a core part of Somerset's DNA. So what did that mean for us? It meant very early on in this crisis, we were able to get a really good picture of how Somerset would look under a very stressed scenario. And the outcome was, even if we had this situation for significantly longer than anyone expects, they'd be absolutely fine. Their balance sheet would ride through this. So three key takeaways there. The best leaders are compassionate, calm, and prepared. And the final thing to fall out of our process over the last 6 weeks was capital raisings. So to give you a stat there, we've already had the same amount of capital raised from the New Zealand equity market that we had in the entire GFC. So one key point there is, if we think back to the third question I asked companies, which was, what's a likely outcome for your revenues and profits? We really liked AIA's approach to that, or Auckland Airports, which was, we don't know, but what we're going to do is raise enough capital to take any balance sheet stress or funding stress off the table for the next 20 months, right through to December 2021. So the second part is on performance, a little bit more granular than normal, like the other guys, because we are in a crisis or have been going through a crisis. But in March, we were down around 12% versus the market, down around 13%. That's in New Zealand, the New Zealand Premium Fund. And since then, you know, like everyone else, we've been participating in the rally. So month to date in April, we're up around 9% versus the benchmark up around 6%. But bigger picture, to give some context, for the 12 months to 31st of March, we're up around 4% versus the market down around 1%. Our best performers in that critical month of March were some of our biggest positions, so A2 Milk, Fish and Paykel Healthcare, Main Freight and Xero. And our worst performers were really those companies that were in the eye of the storm, so Vista, Serco and Auckland Airport. And on the Property and Infrastructure Premium Fund, just in the interest of time, the bigger picture over the last 12 months to March 31st, 2020, we're down around 9% versus the benchmark down around 18%. And the best performers there, like Robbie was saying, have been our data-focused plays. So our US cellular tower operators who sell space on towers to the key telecommunications carriers. And they're really that rare beast, that mix of growth and infrastructure. So you get your growth on the one hand, and you get your sustainable or secure revenue stream on the other hand. And the final section is on positioning. So in both New Zealand and the property and infrastructure funds, we've been avoiding weak balance sheets. But there's no silver bullet, there's no change in our process here, it's more of the same. So we're focusing on buying high quality businesses with high quality management teams that are really stepping up and being calm in this environment and have very long runways for growth, almost irrespective of the economic backdrop. So in New Zealand, just to finish off, we've been buying some of the best companies in New Zealand. We've been buying Auckland Airport, we've been buying Main Freight, and we've been buying Infratool on this pullback. So thanks for your time this afternoon.
Great, Sam, thanks. Look, I think just hearing the guys talk there, one of the things that really stands out for me is that our job as an active manager is to find companies that are better than the average. And if we do that consistently, we will beat the market. And certainly, I think in times of stress, that is a time where I would expect our strategy to work and to beat the market. And the good news is we have done that across, you know, New Zealand, Australia, our international portfolios, across our P&I portfolios. You know, that steep approach, finding quality, well-managed companies that can grow, has protected capital in a very difficult environment, but has helped protect capital in the downturn. And we think is actually going to be a great strategy as businesses recover, because those well-led, well-managed businesses that can chart the next set of waters that we go into, they'll be the ones that lead the world out of this as well. So I think those stories are really, really good. We've got some really cool questions coming through. I'll kick off very quickly with Sam just on AIR. I think it was kind of implicit in your comments, but we did participate in that capital raise. Just want to give people a bit of colour on your strategy around that, and how big a move you made in portfolios to support Auckland Airport through that capital raise.
Yeah, so Auckland Airport raised $1.2 billion, which, like I said, what they did there was raise enough capital to ensure that if passenger traffic at their airport stayed down at current levels, which is down around 95% from normal levels for the next 20 months through to December 2021, they'd be just fine. And it's really important to note that that is not their base case, but that's what they did because they just don't know. So they wanted to take any risk off the table. We took a little bit more than our pro rata share, so we got as much stock as we could in the placement.
Good news, good news. All right, moving on to some other questions here. There's a question here, and I'm not quite sure who I'll get to answer this one. I'll read the question out, and I'll sort of paraphrase it in a way that that makes sense to me, at least anyway. And that is that one of the challenges with investing is that sometimes something that looks like it's a great quality business turns out to have been a lucky business because the environment was really supportive of it, and it gets found out in the more difficult environments like the one that we're in. Have we seen those sorts of things happening in the marketplace, and has that meant that there are changes we've had to make to our portfolios on the back of those, on the back of things that turned out not to be quite as good as we thought they might have been? Who'd like to have a go on that one?
Maybe I'll have a quick crack on that, Frank, and it's more a general observation, and it reminds us of the GFC. And in the GFC, we learned that companies that are supposedly defensive, like a commercial property company, for example, or a shopping mall operator, but have quite a bit of debt on their balance sheet, are found out to be not quite as defensive after all. And we've certainly seen that in the markets, and we've been reducing some of those companies in our property and infrastructure portfolio, because clearly if no one's visiting your shopping mall and you have debt on the balance sheet, well, then you're not as defensive as you might have thought. And that reminds us of the GFC.
That's a really, really good point. That debt is just unfortunately it's a challenging place to be, and there are way too many companies globally who have borrowed money that frankly shouldn't have. Thankfully, they're not the sort of things that we typically own, but one that I know Ash talks about a bit is retailers in the US. Retail is a very geared model anyway. They are the worst kind of companies in the world to borrow money, but yet they've been borrowing it like crazy, and yeah, there will be some pretty serious bankruptcies in that space over the next little while. Another great question, this one is for Dave, and I'm excited about the answer to this one, and that is, can you just run us through, Dave, what the heck quantitative easing is all about? It's one of these words that gets thrown around all the time. It's in the press every second day, but I don't think many people actually really know what it means, and I guess, what does it mean, and what might it mean for the economy and for us as we live our daily lives? Dave.
Sure, Frank. Yep, I'll try and keep this one short and not bore you too much. But quantitative easing is simply an asset swap. So what actually happens is that the central bank, and in this case, let's use New Zealand as the example, because the Reserve Bank of New Zealand has just started doing this itself over the last couple of weeks. So the Reserve Bank of New Zealand steps into the market and buys government-issued bonds. Largely, it's buying now local authority bonds as well in small size, but let's just say it comes into the market and buys outstanding debt that has been originally issued by the New Zealand government, buys it from a bank, from the big market makers, and what it does is by doing that, it gives those banks a credit on their settlement accounts. Their settlement account is just an account like a deposit account that sits actually with the Reserve Bank of New Zealand itself. So the banks have their own bank account with the central bank. Makes a bit of sense, right? That money or that credit is not money as we know it. So it can't immediately go out into society and be used to buy milk and bread. It is a credit on their account. The banks themselves have to create money on their own, which is basically by making a loan. Every time they lend money to you or I through a mortgage or through a personal loan, they are effectively creating money. The central bank does not create money through quantitative easing. It is just swapping a credit for a bond. So that is not actually money creation, as a lot of people do call it. And I suppose that probably brings me onto another point, and one that you probably want to know with regards to why do quantitative easing then, and why is it important? Well, why I think the central bank stepped in and started this type of unconventional monetary policy is because, again, going back to my earlier point, the funding markets for not only companies in New Zealand, but the government itself was starting to become very unstable in March. We saw wild swings in the yield or the interest rate on even government bonds, not only in New Zealand, but even in, say, the US Treasury market, which is the biggest, typically most liquid fixed income markets in the world. So again, that was that freezing of the funding markets, and it was happening at the core of those markets, the government bond markets. Central banks had to stop that from getting any worse, because then, as I say, without that oil in that machine, the machine would have ceased. So they came in and started buying these assets in very large size, both in New Zealand and overseas, and that has freed up those funding markets again to start to function again, to be able to flow that money back into the system. So QE has a purpose. It isn't money creation though, but it does have a purpose in trying to drive down yields and allow funding markets to continue to function.
Thanks, Dave. Another great question here, and I think I'll have first crack at this one, but feel free, guys, to contribute. And that is, and I'm just going to read the question here, but for those of us with a bit of spare cash, when's a good time to start investing that? Or actually, I will say the question was sending it to Fisher Funds, which I think is a very nice way of putting it, but I'll make it a bit more general. And I'm going to cede my answer to somebody way smarter than I am, who writes very, very eloquently, and that is a guy by the name of Howard Marks, who is runs a big fund in the US focused primarily on debt markets in the same sort of area that Dave works in, although they do a lot of distressed securities and all sorts of weird and wonderful things. But he made some comments in a recent piece that I think are really good on this, and that is first and foremost that we should be thinking more about, is this a good time or a bad time? Is it a good time? Is it a time to be offensive or a time to be defensive in portfolios? Not is this the best time or the best day to make your investments. And his basic kind of comment was that an investor, and I'm reading the quote here, but the investor's goal should be to make a large number of good buys, not just a few perfect ones. And what does he mean by that? He means that we will never, I shouldn't say that, I've got some very smart colleagues, but we will invariably never be able to pick the bottom of a security price or the bottom of a market when we look to invest capital. The job really is to make sure that you're on the right side of halfway all the time, so that we take advantage of the Starbucks, which it's definitely cheaper than it's been. We take advantage of the REAs. That's a business I know really well because I've looked at that for years and it's always been expensive as well. When it looks like it's reasonable value, then we should begin to at least start to build a position in a company like that. Will we pick the bottom? No, we won't. Do we hope we will? Of course we do. But you know that if you buy great businesses at reasonable prices and you just keep doing that year after year, you'll accumulate a lot of wealth. And I think the same thing is true when you're running a portfolio as it is when you're managing your own money. If there are opportunities and good assets to buy at reasonable prices, then you at least get the ball rolling. You do need to have some courage to do that, because just because it's cheap doesn't mean it can't get cheaper. And we've certainly seen that happen in markets, but it's a lot easier to make that call today than it was a few months ago, should we put it that way. So not sure if anyone wants to add anything to that, but yeah, trying to be the smartest guy in the room, it's awesome if you can do it, very hard to do. Guys, I will hand over to the smartest guys in the room.
I think you answered that well, Frank.
Yeah, I was saying my only comment there would be at an individual stock level. We are seeing more opportunities now, in my opinion anyway, than we've seen for 5 or so years. So when you look at markets and you think they're good individual companies that you like, you think are trading at attractive prices, and you think the time is right to buy, that probably also makes sense from a personal portfolio perspective. If there's lots of opportunities out there, it's probably not a bad time to start allocating more into risk assets.
Couldn't agree more.
It's Kath here. I just thought I'd add, really good opportunity or time to talk to your advisor as well, so they can give you some good advice about what's right for you and how to do it in the best way. So I thought I'd chuck that in there, Frank.
No, very good, very good. Hey, we've seen a number of companies around the world cancel dividends. We've seen things like the Reserve Bank of New Zealand cancel the dividends from New Zealand-based banks back to their Aussie parents. What do we think the impact will be of reduced dividends, and does that affect the way that we invest money? Is a question that has come in, and I think it's a very good question. So, Ash, do you want to have a chat on that one?
Yeah, and we have certainly seen a lot of companies cancel dividends, both in New Zealand but also around the world. And it really does depend on why they're cutting the dividends. In some cases, it's just simply out of an abundance of caution. Auckland Airport's a good example, which we think is a business with great liquidity. Sam's already talked about that. They cut their dividend, but that's not a situation where investors should be concerned. On the other hand, a lot of retailers in the US have recently cut their dividends. Department store chains is an example. And a lot of them, Macy's, I'll give a specific example, is a company that probably shouldn't have been paying a dividend for the last 5 or 10 years. They've essentially been borrowing money in order to pay dividends to their shareholders, and effectively making their financial position worse and worse through time, through a period where they probably should have actually been shutting down stores as they've been competing with online retailers. So you really have to look at each company individually. What are the reasons for cutting dividends? What's their financial position? But overall, if you're investing in a good business and they've cut their dividend for a year because they're through an abundance of caution, that's probably not going to change your ultimate return over the long term by very much at all. So the point, I guess, is you just have to be really careful and look at it case by case. Some companies are cutting it because they really need to.
Okay, and Ash, in terms of our investment process, do dividends feature much in the way that we tend to think about companies? And maybe Sam, if you want to chime in on the P&I fund, because it might be a little different there. But
Yeah, and with in our fund, very few of our companies actually pay dividends, and if they do, they tend to be quite a low level of dividend. Would far rather see a company reinvest capital. We try to invest in good businesses that have a lot of growth ahead. I would far rather see Starbucks, as an example, continue to keep the money themselves, reinvest in rolling out new stores at the great returns that they get on those incremental stores, rather than passing it back to me as a shareholder. So from my perspective, dividends don't really have much of an impact.
Correct. Sam, if you want to add anything from the P&I perspective on that.
Yeah, just to add that there is a component of the P&I portfolio that is invested in more traditional, more sustainable infrastructure that does pay a dividend, like our US utilities, our water and gas utilities. They've performed quite well during this. But then there's another big component of the P&I portfolio that's focused on growth. Like I said, our growth infrastructure assets in the towers, and while they do pay a small dividend, it's much more about the growth and reinvesting that capital in their own business, like Ash said.
Cool. With that dividend topic, and we obviously talked about the RBNZ stopping dividends from New Zealand banks back to their Aussie banking counterparts, and I know APRA has looked at whether or not Aussie banks should be paying dividends. Is the banking system in Australasia something that we should be worried about as investors? Because I have heard some people voicing concerns about it, and how do the banks today stack up versus the banks in 2008, when there clearly was quite a lot of pretty justified concern? Sam and Dave, maybe one. Robbie and Dave, probably one for you two. You can fight over who gets first dibs at it.
I'm happy to have a first crack at that, Dave, and feel free to chime in. Yeah, Frank, in a nutshell, the Australian banks anyway are in a very strong position. So there's no need to be concerned about the banking infrastructure, we don't think, certainly from the Team Aussie's perspective. If we think about it from just in 3 ways, the banks need to be in a strong capital position so that they can withstand rising impairment losses into a downturn. They need continuous access to funding because without that, they can't then lend to consumers. And on the consumer and business side, they need to make sure that lending can get out to businesses and customers that need it at a rate that limits the impairments, which will come back and chew out the capital balance of the banks. And if we think back to where the banks were in 2008 versus now, in 2008, the banks had half the capital levels in Australia that they do today. So they're far better capitalized to withstand rising impairments this time around. The funding base is very stable in Australia. It's a whole raft of measures that APRA, the prudential regulator, and the RBA have put in place over the last decade, have ensured that liquidity, funding ratios, and so on are a lot better than they were back then. And the RBA, as part of some of its supportive measures for the banking system, has stepped up and ensured that the Aussie banks will maintain access to funding through this period. So that's secure. And then on the other side, absolutely the impairments are going to rise. Businesses will go bankrupt, consumers will come under stress to a degree. But again, we've had this as part of Team Australia. We've had the Aussie government step in with a huge amount of fiscal stimulus, which should help dampen the most extreme effects of that. So I think the banks are well positioned to withstand this. They probably going to cut their dividends. You know, that's certainly getting factored into their share prices at the moment. And, you know, given APRA's requirement or suggestion that they think very long and hard about whether they pay dividends this half year, a bunch of the banks are due to report in May. We suspect that they may defer dividends for a while, but to the extent that the economy improves, we could see those getting paid out towards the back end of the year. Dave, I don't know if you had anything else to add to that.
Not too much. I'll put a couple of numbers around it, Robbie. I definitely agree with all that you've said. You know, as far as just trying to put all of this into context, credit losses for 2020 will probably be around about 5 times, so 500% bigger than they were in 2019. Right, some big numbers, right? But that is, when you then put it into real context, that is around 1% of all outstanding loans in that banking system. Still a very, very, very low number. Earnings, sure, as Robbie pointed out, will be lower, probably in the vicinity of 10 to 15% on last year, and that's, you know, that's a big hole for sure. But again, back to Robbie's point, the level of capital that these banks now hold puts them in very, very good stead. They really have the highest capital ratios of any banking industry in the world. They certainly, thanks to their regulator, APRA, have been forced to do this. So they go into this crisis in an extremely strong position. So yeah, the numbers look big, but in the grand context, that I think they will do just fine through this.
Good. Hey, I'm conscious of time. There's one last question that I think would be really good to cover off on. And look, before I even ask that, thank you everyone for participating. If you do have any insights and ways we can make this easier, better, and work better for you, please do feed them back to your advisor or to me. But for the last question, Sam, you're on the dais. I'm just really interested in what it is that marks out the best companies that we should be owning that will participate in the recovery, and what is it they're doing today to really position themselves for that, and that ultimately gives you confidence that they'll be great performers for the next 3 to 5 years as we eventually recover from this.
Yeah, thanks, Frank. So again, there's no silver bullet or no change in what we have been thinking and doing. So those companies that are giving us confidence are those companies that typically don't have stretched balance sheets to begin with, have very high quality management teams that are stepping up in this environment, that are really looking after their teams, and their teams are looking after them, and companies that have a really long runway for growth, almost irrespective of the economic backdrop. So we take Xero, for example. Cloud accounting penetration in their core cloud accounting product globally is 10%. So while the pie may shrink during this, which is the pie is the overall number of small businesses out there that can take this product, it's much more about for them taking a bigger slice of that pie. So no real change, no silver bullet, just exactly what we have been focusing on for the last 20 years.
Superb. All right. Hey, thank you very much, team, and thank you very much, everyone, for attending. And yeah, please do get that feedback to us. That would be superb. Thank you.